Hello and welcome to Money Marketing Wired Outsourcing Session, sponsored by Brooks Macdonald. In this session, we'll be exploring the risks and rewards of outsourcing investments, looking at regulatory responsibility, examining the changing relationship between client, advisor and discretionary fund manager, and addressing any poaching concerns about the new setup. My name is Cherry Reynard. I'm a regular money marketing columnist and freelance journalist. And helping me to answer these questions will be Andrew Shepherd, Managing Director at Brooks Macdonald, Chris Davis, Director at Engage Partnership, Kim North, Managing Director at Technology and Technical, and Clive Summers, Compliance Consultant and Client Services Director at Resources Global Professionals. We welcome you all. We are live today, so if you have any questions for our panel, please use the box on your screen and we will do our best to tackle them over the course of the next 15 minutes or so. And if you are tweeting while watching the show, please use the hashtag MMWired and we will try and give you a mention. I wonder if we could start today with a little discussion about the backdrop. To what extent do you believe outsourcing is a prerequisite for smaller directly authorised advisors now? And if so, how much and how does it benefit those firms? Could I address that to you first?
Of course. I was a small directly authorised financial advisor in the 1990s, and we found there was two of us as regulated individuals, and we found that there was too much regulatory burden for us to run a proper business. You know, we couldn't grow it any further. There was about 60% of one of our time being taken just dealing with that. So we sold out in 2000. I say sold out. We sold the business in 2000. We're 13 years further down the line, and I don't think that the burden has lessened any. So I suspect that the requirement for outsourcing is greater than it was then. Indeed, the amount of systems and controls which are required now to do investment management, which no doubt we'll speak about a bit later, I think is huge. And so for a two-person business as we were, there's no way we could handle that today. Equally, I think that clients are actually looking for their advisors to talk to them, to review their situation with them, to show them the plans, not to sit there and spend hours and hours trying to implement and do research. So actually the advisors should be able to focus on the key part of their value proposition, which is, you know, adding value to the client on a day-to-day basis through this partnership, sitting alongside them.
Okay. And Kim, I mean, do you think that advisors need to outsource kind of wholesale, or can they keep some of it in-house, or is there a balance that can be achieved?
I think gone are the days if you take a long hold on a quality British or American stock. The markets, having seen the financial crisis 2007, means that the time required to actually monitor investment markets is increased considerably over the last 10 years. For small IFAs or restricted advisors, I think the best thing to do is get a DFM, a discretionary fund management service, via a platform and offer clients that service. There are a few firms that are very well established where they've got full-time IMC qualified individuals that will be able to manage and make recommendations directly on funds. But I believe if you're small, anything less than 5 registered individuals, I think you need to really seriously consider outsourcing the vast amount of your clients to a discretionary fund manager. It de-risks the business. You've got a wider choice and continual meetings with the DFM to match your client's risk outlook and tolerance to loss.
Okay. Maybe you could expand on that a little bit, talking about the benefits. There's a lot of talk about how sort of advisors are being pushed in this direction, but there must be some upside as well for them.
Yeah, there's lots of upside. I mean, the big thing is what we call advisor alpha, which is effectively what do they do best. And advisors are fantastic. I know I've been one for 10 years. They are very, very good at the relationship, building relationship capital with clients and developing, these partnership relationships that we talk about, which involve, the high trusted element, which is, you've mentioned the financial crisis, which is much needed. So what the outsourcing will do is basically they can then focus on, what is important for them. What they, with that comes risk. So obviously what you've got is you've got to manage the fact that, there is a relationship there. There's actually a 4-part relationship here. You've mentioned platforms where you've got effectively the client, you've got the advisor firm, you've got the platform, and you've got the DFM. So that needs to be managed very, very carefully. But if it is, and it's managed tightly, then the advisors can really just focus on what they're really, really good at.
Okay. Clive, do you have anything to add to that?
Well, certainly for smaller firms, I think, the market's become more and more complicated, more and more products have been designed over the years. So, as a minimum, some form of research outsourcing is needed. There is a challenge in wholesale outsourcing to DFMs, all firms taking that approach, because ultimately the advisor's responsible for suitability. And whether we like it or not, a discretionary offering is sometimes seen as a more sophisticated approach. So there's a lot of issues. There's certainly pros and cons, and certainly smaller firms have got to think, particularly if they're going to be independent, they need to outsource some element of their research. Much more complicated products require more enhanced due diligence, and I just don't think small firms can do all of that and evidence that they're independent.
And do you think that smaller advisors get that while they can outsource the process, they're not outsourcing the responsibility? Do you think that message has been reasonably well understood?
I think for some, yes. For others, maybe less so. Again, it really depends on how they're operating and I suppose what analysis they've done into the outsourced sort of relationships they establish. I think it's very easy as an advisor to refer or introduce your clients onto a third party and assume that you've outsourced responsibility, but again, we've got the suitability rules which require them to make sure that that is the right thing for the client. And of course, it's this communication piece about making sure the client understands who's responsible for what aspect of the relationship. So in simple terms, if you refer to a discretionary manager and it's crystal clear that the discretionary manager will have a relationship with a client, to some degree, as long as that's communicated, you have outsourced that investment management responsibility. But alternatively, you've got platform and model portfolio approaches where the position may be much less clear.
Yeah, I mean, do you think there is a potential problem with the risk profile not sort of adequately mapping to the outsourced solution? And if so, have you found ways to deal with that? Is it ongoing monitoring or?
I think, let's call it centralised investment proposition as SIP, which is the regulator's wording for this outsourcing. I think we end up in a situation where we try to avoid what I call portfolio slide, or we need very efficient rebalancing. So this is an ongoing process with your outsourced fund managers to ensure the risk profile of the named funds which clients originally went into, there's movement within the holdings within the fund. We're now seeing a lot more of the DFMs. And that market's huge. There's over £300 billion in under discretionary money in the UK. That we're seeing more sort of dynamic tactical investment offerings instead of simply trying to follow a benchmark. So from a risk point of view, rebalance the portfolios to match the client's risk outlook and capacity to loss, and ensure your outsourced DFM knows exactly the risk profile of the client.
I think there's a key issue on this because we took this to the FSA as they were last year. And the key issue is that there's no calibration, if you like, between, for example, the synthetic risk-reward indicators of the DFMs that they tend to use and the client risk profiling. And our approach is kind of like we look at it in three ways. We say, well, what are you doing on the client risk profiling area, which is effectively looking at three things. I think you mentioned a couple of them, which is risk capacity, tolerance, and risk required. Then you can use all your enabler tools, such as the risk profiling tools. Then you've got a gap analysis, really, to look at, on one hand, you've got the DFM or whatever you're using on the risk side, and then you've got effectively the client risk profile. And then you've got a knowledge transfer issue of how good are your meeting skills, your soft skills, your suitability reports, in getting what we call client-informed consent. That is essential on this, so they really understand and get, that risk profiling calibration issue. And I don't think the regulator have done enough on that yet.
Okay. Did you have something to add to that? Yeah.
Yeah, I absolutely agree with you. I mean, we're very key. This brings it all together, really, that, on suitability, we're responsible for ensuring the portfolio is suitable to hit a particular mandate, but the advisor is responsible for ensuring that mandate is suitable for the end client. How that links in with risk profiling and mapping, I think, is a really difficult area. The advisor needs to understand the way that the DFM is actually running money to ensure that the portfolio is still suitable for their client on an ongoing basis. And I think the DFM industry has to take some responsibility for ensuring that the advisor has enough information to make that decision on an ongoing basis. We have to do some work, quite a lot of work, I think, with the different with the different risk profiling tools that are out there. And there are sort of 3 or 4 main ones, but there's a lot of proprietary stuff out there as well. So as we can guide the advisors as best we can, acknowledging that at the end, it's their responsibility to make that decision. We're doing a lot of work on that at the moment.
Yeah.
Okay, we've had a question actually from Peter Hurd on this subject. So, who wants to know if an advisor recommends a DFM and that DFM mismanages a portfolio, who ends up paying the compensation? So,
well, if we mismanage it, then we provide the compensation. Yeah.
Okay, right.
And that's where it's critical to get that relationship and responsibilities, you know, clearly set out at the start. You know, and back on those risk tools, you know, it's critical for the advisor to understand how those tools work, you know, as you were saying, because if you're just completely reliant on a mechanised tool and you don't really understand what drives the outcomes, you won't really know whether your client's ending up in the right risk profile place. So the tools are very much an information gatherer, start of the process, and really the advisor should be challenging, looking at those outcomes and making sure that when they talk that through with the client, actually the output of the tool reconciles with what they actually feel is the position. I think once they're through that hoop, they can then more confidently move into, you know, either model portfolios or different discretionary options, if that's the sort of thing that they're linked into.
And one of the things actually is quite interesting on that question is that, you know, just been an NRAC at the moment, but, you know, 9.2.2R is all about advice suitability and risk profiling and getting that right. And then you've got FG 1105, the paper that came out last year, is all about that too. And what I was surprised to read in money marketing actually was the FCA coming out and saying, well, you can take this enabler tool, risk profiling tool, at face value, and, you know, we think that, you know, there needs to be far more work involved in understanding the algorithms, understanding, you know, what goes into that to give that risk profile and then map it against the fund managers and see how that works. So it's
we had that shake-up, didn't we, there a couple of years ago, whereby the regulator said 9 out of 11 of the risk profiling tools they'd actually researched were not good enough. There was only 2 good enough, one of them from Etica and stuff. And, you know, I'll put it to your compliance background. What are we going to do about risk profiling tools?
I mean, they're just that. They're a tool. And I think, you know, whilst, you know, what FSA said in 2011, you know, as you say, 9 out of 11 weren't fit for purpose, as it were. I'm sure you can probably say that those 9 have probably done the work that they believe is necessary to make sure their tools are appropriate for use. But again, without if the advisor doesn't understand how they work, hasn't done enough due diligence into the mechanics behind them, then, you know, they're at risk of a particular weighting of a particular question driving an outcome. And, you know, for example, we've seen some risk profile tools which have a very high weighting on the term at which the client wishes to invest. And that almost overrides some of the more critical questions about their views on taking risk. So if you can invest for over 10 years, you're almost going to be medium to higher risk, irrespective of some of the other answers you give. So it's about understanding the tools. And, you know, there has been some quotes of things that the FSA and FCA have said. And I'm not sure that what they've meant to say is that you can take at face value risk tools. I think that some of their comments may have been more about factual research on products, so performance data and that sort of thing. But, you know, it's a challenging area, and you know, I think any advisor that goes into an outsourced arrangement just needs to make sure they understand the parameters and communications.
Well, I mean, what about things like the underlying investments within a sort of outsourced solution? I mean, some of them can be quite esoteric, you know, absolute return strategies, volatility solutions, that sort of thing. To what extent do you think the advisor needs to understand the real nuts and bolts of the investment proposition?
I think they need to understand that proposition and know what is within the outsourced investment proposition. You've got some providers. We've seen a massive increase in the number of DFMs available on platform, and some of those are huge banks where they might go as far as ETFs, CFDs, very esoteric. And the IFA has got to be able to, under disclosure. One of the things the FCA is saying on outsourcing, there's not enough disclosure up front. The illustrations are too complicated. The information that's provided is not straightforward enough. IFA or restricted advisor will be in breach if he or she does not understand what that underlying DFM is providing.
Okay. If we could talk about fees quickly, there is a sense that any fees charged to the advisor now, shared between the discretionary manager and the advisor. Have you noticed any sort of pushback from clients on, well, what am I paying you for if it's not? I mean, have advisors sort of come to you and said that's a problem?
Yeah, and it's a problem that's been going on for some time now. It's not just with RDR, because the preparation for RDR has brought it up, and we've been very clear. I mean, to the extent of having multiple pages on justifications of fees. Getting advisors to understand, without trying to teach them to suck eggs, what the value that they're bringing to the client actually is. And we strongly believe it's not filling out a portfolio with the funds that you like. The days of the highlighter in Investment Week are long gone now. So they add so much value in so many different areas that just running through them with that, and I've done it 50 times, I guess, going, this is actually the area where you're adding value, and then expressing that to the client and understanding your own value proposition. That's the key.
I think that's right. You hit the nail on the head. I mean, what we do a lot with advisor firms is look at value process documentation, which is basically what are you doing for the client? That's the litmus test in anything. Where it comes to fees, you've got to be careful, because if I'm an IFA and I'm outsourcing to you, then is intermediation broken? VAT and all that type of stuff. Therefore, is my advice 20% more expensive? There's all that type of issue that needs to come into play. So the value process documentation really is all about showcasing, what I am actually doing for the client. And once the client sees that, and I worked in Australia in 2004-05, they had a big issue then about this because it all went down the platform route. And it's what am I actually doing for the client. So if you can showcase that, you can do it through a value process documentation, showing your philosophy, how you're implementing, how you're resourcing and researching, that I think, and the roles that you're playing, that I think is key to that, and justifying your fees, because clients will pay if they see the value.
Okay. Yeah. I'll just ask this question quickly. We've had a question from Tony Horn saying, is offering a non-advised solution an alternative to outsourcing?
I don't know, really. Non-advised is a proposition in its own right, and so ultimately, you're offering either you're offering a series of products that the client chooses to buy, or a process whereby the client makes their own decision. Whether that still leads to outsourcing or not, I suppose it's very much depends on the process that you're running. So I don't know that it's an alternative, but it's part of the process. It might be for certain films.
One of the issues with that is one, well, probably two words: decision tree. If clients are going down a decision tree, then you go into, if it looks like advice, it is advice, suitability, and that type of stuff. And then you've got the double lock regulation between appropriateness and suitability. So there's all sorts of stuff. I don't think that's a clear-cut issue.
Yeah. We're seeing an awful lot, though, of non-advised online propositions that are outsourced. Informed Choice, Hargreaves Lansdown have done it for years. And I think the problem is, with RDR coming in, advisor charging has pushed out millions of UK people that cannot afford the advisor charging to go face-to-face. And therefore, they're being pushed online and able to just say transact, but making their own decisions. It's like you said, the difference between advice and guidance is very, very narrow. But as long as you stay on the guidance, not advice, online, outsourced investment choices made available online for clients, I think we're going to see a proliferation, it's a big word for Monday morning, proliferation of these online offerings.
To be fair to the regulator, I know they are looking at this, and they are looking at, D2C, for example, and that type of stuff, and how, if advice is compromised or whatever, what can they do to actually help that position? Because, as you say, we've got a disenfranchised mass market at the moment.
I think the online offering is is certainly going to continue growing, and we do a bit of work in that area, helping firms try and make sure they're not crossing that boundary between advice and a genuine non-advised solution. I think the internet is the way for it, though, online, because that where you get that human interface, the risk of an opinion or advice is increased.
Which is why the banks are not getting involved in this area anymore. Some could argue is a good thing.
I wonder if we could just wrap up by talking a little bit about where advisors are still reluctant to use an outsourcing solution. The drivers behind that, are they worried that people are going to poach their clients? What are you finding?
Yeah, that's it's definitely the case, and with good reason. In certain situations, there's a history going back of a certain lack of trust by DFM stockbrokers of the IFA community and vice versa. What you're seeing now is a lot of DFMs actually have in-house financial advisors within their proposition. I think what the advisors have to do as part of this is when they're doing their due diligence on the DFM community and deciding who they would like to outsource to, they need to look at the firms, look at their history of working with advisors, look at the history of potential poaching incidents, or what are the opportunities to poach. I mean, we get 90% of our new business and existing client base from the IFA community. Now, if we were to poach a client, we'd never get another one. So we're not going to get involved in that, obviously. But I think it's in that DD process you go through at the start.
Yeah.
And I think, after 30 years in the industry, we've always had providers of products or service poaching intermediated clients. But I think the market's now so mature, the DFM will not survive in the intermediated space if it tries to communicate directly with clients to poach them.
Advisors can protect themselves as well. As I said, at the start of today, is, what they can look at is this 4-part agreement to get that right and get that really watertight, so that they've got the agreement with the DFMs, and they've got the agreement with the platforms, and they've got the agreement with the client. That is essential. And what we've seen is not enough has been done around that particular area, because if they are concerned about it, then they need to be getting on with it now.
Yeah. Just one final question from Graham Weathered. Can you see further growth in the DFM market? I mean, there's been a huge, as you say, huge growth in the number of these outsourced solutions. Do you think that's going to keep going?
Probably, yes. I suppose, these things sort of ebb and flow, really. But I mean, I think it's probably something at the moment, that will continue to grow.
I think where I've been for the last 11 years, Asia, it's grown exponentially. It's huge, the DFM market, and you can see it coming over here. And I actually don't think it's a bad thing if it's done correctly and professionally, etc. So, and for advisors, from the regulatory point of view, advisors are no longer regulated as distributors. They are professional firms in their own right, and they need to act that way, and a lot of them do. But that basically means is using the outsourced solution is a professional solution if it's done properly. Yeah. So with the growing market, they need to get involved in it.
And presumably those solutions are increasingly differentiated. I mean,
there's quite a lot of offerings out there that are quite similar. You mentioned absolute return funds, and there's only a handful of absolute quality esoteric DFM offerings to access Asian bonds, for example. But I think a lot of these DFMs need to concentrate a lot on the marketing and the PR and what their actual offer is, not just using the analysts saying our performance is great, They need everything to go with it to give them a USP and stand out.
That is one of the risks, obviously. The more DFMs there are out there, the more portfolios there are going to be to choose from, and only so many can be performing at the top.
Yes.
So there could be a bit of a shakeout at some point further down the line.
Yeah.
I think there's a number of third parties who you can use to help you differentiate in these areas. I mean, De Facto is a good example. They do a lot of work with the DFM sector. ARC, Asset Risk Consulting, their private client indices at the performance end of it. And indeed, there are people looking at your back office as well now. So you can tick a lot of boxes just in that area. But there's a lot of similarity between the different solutions. So you've got to differentiate yourself in some way or t'other. And, we sit there and we've got 14 people out on the road talking to IFAs on a daily basis, whose job it is to consult with them and help hopefully take them to the next stage in their businesses.
Great. Well, that seems like a good place to wrap up. We've run out of time. I thank you to Andrew Shepherd, Chris Davis, Kim North and Clive Summers for joining us. An on-demand version of the show will be available shortly. Thank you for watching, and goodbye.